All right, so we started off the day and went throughout the day with some weakness, but followed a very familiar pattern recently, especially in the last few days, of rallying into the close, coming off of the lows, kind of producing some lower shadows. That's actually been a relatively familiar pattern for the last couple of weeks. Before this week, we had some lower shadows for the weeks of some closes, rallies into the close throughout the full day. Thursday and Friday the week before, Friday last week, and then this week, Wednesday, Thursday, and Friday, not quite getting all the way up, but at least coming off of the lows each of the 3 days. So it's a buy the dip is still very prevalent, but a very small range this week. So I'm going to highlight that and talk about its significance. Very strong negative correlation continuing this week. Up to extreme levels now between the Qs and IWM. So we're going to show those patterns, talk about that significance. We're going to take a look at a very interesting move in the dollar and its impact on charts and different asset classes and what that means. Bonds, what they're on the cusp of doing. We'll talk about that as well. Some interesting sector moves, a very distinct, unique pattern that I haven't ever seen before. I'm going to show you what that is and the sector rotation. And then we'll take a look at our trade idea of the day of a stock that gapped up huge on earnings and hasn't gone anywhere and now is susceptible to a familiar move itself from current levels to the downside. We'll talk about how to trade that. As well as always, trying to hit that 10,000 mark on YouTube. So if you haven't subscribed to our YouTube channel yet, make sure you do that. I'll show you how here in a minute. With that, let's go ahead and get started. Today is Friday, May the 12th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Hey, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out some of these other things on the right, including the Market Outlook Live that I did today at 3:30 Eastern Time here. We do every time I do the Market Outlook, we do those. Come down to the bottom, click the heart. It opens up this tab, and hit the like button that pops up when this tab pops up there. So hit that like button there. Same thing with the Facebook icon. Click the thumbs up icon in that icon right there. It opens up this tab. Hit that like button. Again, the more you do that, it helps us get our content out to all of our followers on Twitter and Facebook. That's why we always ask for it. So thank you for those that do that. We got above 100. If this page will show up here at some point. We did get above 100, so we really appreciate that. So thank you very much for those who click on those like buttons day in and day out. For those who don't, you can do that. You can just click on, with one or two really easy clicks, you can be able to do that right now while you're watching. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we finished the day above the 30-day moving average. For a good chunk of the day, we were below it. So we actually had another bull tag for most of the day today. But that last rally, we've been getting, look at the long lower shadows we've been getting lately. We've been getting moves off the lows of the day. Well, now 3 days in a row to where we pretty much closed near the open. Not quite this time, but a little bit further away this time. But at least got back above that moving average, like I said, avoiding the bull tag for now. You got the light pink shading again because the intermediate line is dropping, but we didn't close below the moving average. In fact, as you can see here, we ended up closing 0.06% below the moving average. That's it. That's not very much. But enough to keep, again, that bull tag, right, from what happens when you close below and the intermediate line is falling at the same time. So you can kind of see here when you transition from dark green to light to pink, and you have a yellow line too, that's when you get these. And we were transitioning from green to pink again, and we were getting these. Now we did on the Dow Jones, we got the bull tag originally when we transitioned from green to pink, and we easily closed below the green or yellow the 30-day moving average the last couple of days. So we're 1% below on the Dow. We did, however, with the intermediate, with that rise at the end of the day, we did, however, avoid crossing the intermediate line, crossing below market sentiment. So that's a good sign. It might be delaying it for a day, but as of right now, that's a good sign for the markets. When you look at the NASDAQ, which has been more bullish, remember we actually got a cluster on the NASDAQ here yesterday, and that's our third cluster in this year, in the past 6 months. And the last two signify the beginnings or the end of those intermediate rallies and the beginnings of intermediate declines. Albeit weak ones, but still. And so you'd wonder if that's going to be the case here, especially with your lower peaks on the near-term line, with higher peaks on the price itself going into that cluster. So you just kind of watch to see when that intermediate line, if and when the intermediate line crosses below the market sentiment for that to start. You would expect it would be sooner rather than later based on past precedent during this kind of bearish move we've been in here lately. Of course, the Russell 2000 has been more bearish. And today, even with a little rise at the end, it still did not keep it from turning dark pink shading in a red line. So you got dark green shading in the green line on the NASDAQ with a cluster, no less. And you got the exact opposite on the Russell 2000. So again, kind of showing the discrepancy that we see between the two indexes. Now let's take a look at the 5-year chart, or the weekly chart. You can see, remember we've had two clusters with 2 weeks in a row with lower shadows. This week was one of the smallest ranges that we've seen, 55 points. We had 55 points a couple weeks ago in April, and then now here, almost a month later. So we've had some pretty low ranges here lately. We had 63 over there. Before that, you were back. I mean, you have to go like all the way back over here to get this below 100 at the end of the year with the holiday session. So these are, they have 3 of the past 6 weeks to be at 55 or 65 or lower, below 65. When you look at the range, with the average range for SPX over the course of a week, right now it's at 132. Now it's been dropping. When we started, it was 157, and then we've had these 6 week stretch with 3 of them being really small, being way below the average. Even at 100, even at the low point of the 6 weeks at 132, that's still half, less than half of the average. So really, really small ranges showing up. You can see that showing up as well on the historical volatility has been really small. If you look at it on a weekly basis, it's grinding down to the lowest level we've seen since this whole thing started, right? The historical volatility is actually lower when it started in November. You can see the pickup in the candles, but we've had some really, really small. So here's those same 6 weeks, and we haven't had a single one of the 6 weeks. We haven't had a single 1% gain or loss in the past 6 weeks over the course of the week on SPY. Before that, you can see we had 1, 2, 3, 4, 5, 6 in a row that was more than 1%, and 1.97 there. 1, 2, 3 of those 6 were more than 2%. 2 of those 3 were more than 3%. So we had some volatility, and we've had some really, really light. In fact, you have to go way, but even when we were, before this all started in 22, even over here, you had 1% gains in November going into that Thanksgiving weakness. So you were getting 1% gains or losses during the bullish trend in 21. So this is really abnormal to see, again, a 6 week stretch without a single 1% gain or a loss over the course of a week. So predictably, what that's doing here is it's bringing, on the market forecast indicator, it's bringing that momentum line down. The momentum line, remember, there's a function of range here, and again, it was down more over there at the beginning of the stretch when the near-term line was up and the momentum line didn't stay up. But now, the momentum, after spiking to the cluster on the week of the 24th, where we closed at the high of the week, 2 weeks later now, the momentum line's dragging the near-term line down. The near-term line's below the intermediate line and you can see we're only 3% above the moving average. So you can see the convergence developing on the weekly chart. Of course, look at the Dow Jones, and because we actually had more of a bearish, we actually had a cluster that same week, April 24th, and you can see we've actually been a lot more bearish to the point where we actually have a yellow line on the Dow Jones Industrial Average. You don't have the light pink shading yet because the intermediate line hasn't crossed below 80. But again, bull tags on the weekly chart start corrections. At least these kind of long-term declines. Either that or they start, they are bounce by the dip signals. You just don't get very many of these. You can see 2019 was kind of the last one that we had one of those. And so we'll see, what ends up happening here if we end up getting that same signal. We are 0.1% below. Of course, the Russell 2000, remember, already actually is below the 30-week moving average. The moving average is rising because it's really one drop, and then we've been flat here. Kind of similar to what we had over here. So when we dropped in Thanksgiving, then we went flat for 1, 2, 3, 4, 5 weeks before we fell down. Here we dropped, and we've been flat for about 8 weeks. And you wonder, like, intermediate lines in bearish territory. The near-term line producing this really bearish peak. A drop below these lows would be relatively bearish and again, we would be back to dark pink shading and a red line once that moving average rolls over 4.5% below. Of course, the flip side of this is the NASDAQ, which, again, got the cluster last week, not the week before, but it came close the week before. But last week you got the weekly cluster, and then we're actually up this week. So we didn't even drop at all this week. We're actually up with the intermediate line at the 97th percentile, and the near-term line well above 90 for 2 weeks in a row, and the momentum line dropping again because of the smaller range than what we typically get, 10% above the moving average. So very large discrepancy in the Qs, which remember is 50% of this index. This is basically a 7-stock index right now, because 50% of it is made up of 7 stocks. The other 50 is made up of 93%. So you've got a high percentage weighting, and that's really what's driving a lot of this movement higher relative, especially again to the Dow Jones, where you only have 2 of those 7 stocks in the Dow Jones. They make up about 9.5% of the Dow. As a price weighted average, and then the Russell 2000, where these 7 stocks don't have any weighting at all to them. So you can see their influence on the markets and why it's really driving the NASDAQ in a single direction and the Russell 2000 in the complete opposite. Again, we've looked at this before, but to have the correlation here from when you look at the Qs and you change this correlation to IWM. Let's change it over here as well. IWM, and let's go to the full 3-month period here. Again, the correlation is not very common for it to be that. In fact, if you were to go here, let's change it to a weekly chart so we can see a longer term context on this. And then let's go 20 years and go to a week. You can see it's not common to be 50% negatively correlated, and we've had it twice in the past 20 years, and the first one started the correction, and this one, you can just look at the chart up there. Let me see if I've got those. I don't have those saved, but if you look at the chart, you can see the big change. You can see the change how we've continue to move higher over the last 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks, whereas the Russell 2000 here in purple has been moving lower. So big discrepancy leading to a big negative correlation that you just don't normally see. And what that's done here is it's come over here and it has let's see, not here, no, it is this one. It's come over here eventually. There we go. And it's brought the look at this is the weekly chart of the relative strength, and look at the Qs above 1.5%. This is the first time we've been above 1.5% on a closing basis since all the way here post COVID, going into that correction, and then eventually the vaccine, which started the reopen trade that led the markets higher, but led higher by the reopening stocks, right? But initially, after peaking, we started to have a little bit of a pullback, an intermediate decline. So again, like, we are extremely high. You can see the MACD itself, again, on a weekly chart. Let's scale this out so we can see the longer term view again on the weekly basis. And here, let me get this chart to be a little bit bigger. There we go. So to see, I mean, look at this, is the MACD. It is really, really high. The PPO is just starting to turn back up again. You can see its histogram where it's at. Obviously, the CCI had peaked earlier when this whole thing started. And you have a very strong gap here on the DMI. And then back up here, you have the RSI itself, again, of the relative strength line, well above 7. So needless to say, we are extremely overbought, the Qs relative to IWM. And there's an extreme negative correlation that you just don't normally see. You just don't normally see. I mean, even here, this one started that 15-16 correction when you had that negative correlation of the Russell starting to break down before the NASDAQ did, and eventually everything did, right? So, I mean, even that one started the correction on that point, and you can see a little bit of this one too. This one, actually, the NASDAQ, looked like the NASDAQ stayed flat while the Russell took off to the upside, and then eventually both of them had their intermediate decline here in June when the Fed stopped raising rates, June of 2006. I mean, this is abnormal, to say the least. It is abnormal. Let's take a look at this other weekly chart here that we typically look at. And you can see the transition again. I mean, we continue to get multiple transition candles in a row. At some point in time, we're either going to break back up above this body and just keep being bullish, or we're going to reverse. To kind of get an idea of what we might expect it will do, this is the Dow Jones, and it reversed, right? So we got the transition last week, and now we've reversed with we got a slightly higher high, but we got a lower close with a red arrow, and you can see the PPO is falling. So we're bearish here on the Dow. And then finally, of course, the Russell 2000. We have been bearish. We had the red arrow a long time ago. We're in a death cross environment with a falling PPO, and we continue to get lower closes here. I mean, they're not big candles. You can see the candles. The size of the candles really shrunk, but again, you can kind of see that you would expect that the S&P is going to roll over, considering these other indexes, including the Dow Jones, already has. Looking at the 3 green arrow chart, like I said, we had light pink shading here because we had 3 red arrows. We actually still have 3 red arrows in the Dow. So it's the first day the stochastics turned back down. So we have a day of light pink shading. And again, the MACD hasn't turned down yet here. So again, you have to have multiple days in a row of pink shading to start a trend. And we actually have, 5 days in a row of 3 green arrows on the NASDAQ. So again shows the huge discrepancy in the charts between these different indicators. Looking at the 3 green arrow chart, the S&P, again, for most of the day was flirting with closing below the 17 and the 30-day moving average. Ended up not doing that. In fact, we ended up closing back up above by 0.05 of a point the 8-day exponential moving average. That's how strong of a rally. Of course, it did not produce a green arrow on the MACD. The MACD is still below its moving average there, and the moving average is falling. The stochastics turned down, but still you can see the weakness. Now the Dow has crossed below its 17 and the 30 a couple days ago, and it's still below both now. And its MACD is actually negative, so the blue line's actually dropped below 0. IWM is already at that point, and now has stayed below it. In fact, the diamonds and the Russell 2000 are both below their points of control for the 1 year. Kind of gives you an idea, a reminder from Wednesday. And we are back below the 8 and the 17. They're both below the 30. The 30 is below the 50 day moving average. They're converging, but they're still below it, and then they're all below the 200. So the MACD is above its moving average, so you're kind of converging here, but the stochastics is turning down from what would be a pretty bearish peak if that ends up being a bearish peak there. Your S&P 5, the diamonds, or your DMI, excuse me, is not really showing a bullish or a bearish. In fact, if it's anything, it's bullish. Of course, your diamonds is a different story. Your negative indicator is above 25, and your positive actually is below 20. And of course, IWM is actually trending. Like you're above 25 there. You're still actually above 20 on that one, but only because we've recently rallied here. So a lot more bearish on those two, even if the Qs are the opposite, right? Above 25 and below 20 on the other lines with the rising ADX, and again, multiple clusters there. RSI and CCI, not really, very, very neutral territory for both of them. Not surprising considering how flat we are. Looking at the weekly chart, you can see, again, not really getting into bullish territory there. These are the daily ranges. So we're above 50 on the weekly, but we're not above 60, which is kind of what you need to do to solidify the new trend. And we haven't done that. You see, during that bullish trend, this was again a daily chart, but during that whole bullish trend, at least the green box comes from a daily chart. During that entire bullish trend, we were above. We got above 100. We got up to 150 and above 60 at that point. The trend was well established. That's not the case right now. We can't get above 60. We can't get. In fact, we're getting kind of a lower close. Can't even get above 100 on the CCI in the weekly chart. Looking at the Ichimoku cloud, you can see we are above the cloud. The green line is crossing below the blue, and you are flirting with a negative rate of change as we have no trend there. The diamonds is a different story. The diamonds, we do have a negative rate of change now, and we don't have a trend developed there either anymore on the bullish side. And your Russell 2000 is also a negative rate of change and is below the cloud and has not developed a trend yet either. And again, if we were to start one, you would expect it to be a bearish trend, considering, again, we're below the cloud and you have a negative rate of change. Looking at the Keltner channels, we are still in the upper half of the Bollinger Bandwidth. We flirted with being actually in the lower half again for most of the day and finished in the upper half of a very, very small bandwidth. So that's something there. The diamonds, we were in the lowest quartile of the range for most of the day before finishing higher and getting out of it just barely up to the 30th percentile. The bandwidth is starting to rise as we kind of push against that. Of course, the IWM is a different story again, as we are in the lower half of the chart, but not in the lowest quartile. But we are below the cloud, and you can see the negative momentum over here. Let's take a look at the intraday range. It's kind of an interesting pattern. Look how flat we are relative to the high and the low, which has occurred in the last 4 weeks in a matter of a few days. It's just so fascinating. Now we're smack dab in the middle of that range with an even tighter coil going on here. The point of control, the value area, so 70% of the volume going into this and then coming out of it is only 5 points wide. I mean, the actual channel between the high and the low is really, really low. That's not a big difference here. And the fact that for most of this, like the value area is that small. I mean, we are tightly wound up, and at some point in time, we're going to break loose sooner rather than later, because we are. I mean, the longer we get this wound up, the tighter it is. The more potential energy gets stored into it. The more active energy it produces once it's unwound. So you would expect at some point in time. In fact, when you look at this gap, you can see this gap from May the 5th, which would have been a week ago. This is Friday's gap from last week. We tested it on Wednesday at the low of the day. We came close to it again today. That's the gap that's in danger, right? That we would need to really worry about, of course, is the gap last Thursday that we filled in from the week before that. And so you would expect, I expect, or sometime early next week, Monday, Tuesday, Wednesday, we're probably going to fill that gap in. and that will be our catalyst from a technical perspective, at least, to an increase in volatility that we almost had here before that last little relief rally at the end of the day. Of course, the range today was 4.5 points. Here, let's look at this one. 4.5 points. The volume was extremely light, so below 70 there. So we still have very, very light volumes, very low ranges. You can see the volumes and the ranges at really low levels. That's impacting the money flow. The money flow can't really get above 50, so you still got a really bearish money flow there. We're not very strongly bullish at all. It's also impacting, there's a correlation between that and a lack of breadth. Again, we rallied at the end, but still we're at minus 30, so definitely a negative summation index. Though if you saw, I tweeted out yesterday that we actually crossed below it the day before. So the breadth is not looking very good. Let's look at the new highs, new lows, back below the moving average. They're at minus 25, the moving average at minus 188. So you can see the breadth is not looking good in that chart. And then the number of stocks above their 50-day moving average has dropped below 50%. So again, that's not a good sign. And you look at the average price of the stock relative to the 50-day, we're below it by 0.5%. Again, that's not a good sign from a breadth standpoint, right? And here's the number of stocks that are more than 5%. In fact, I looked at this chart here. I showed you this chart here. I tweeted this one out too. This is the number of stocks below their 200-day moving average. And let's look at a daily chart. Zoom in on a daily chart here. So this is the number of stocks below. We're below. So more than half the S&P 500 is below its 200-day moving average, and you can see the number of stocks 244 is actually below its moving average, which is falling. That's bearish, right? You can see when you're below that, it coincides with bearishness in the equities, and so you would expect that to be bearish. And then you look at the same index for the 50-day moving average. It's the same thing. Again, we're below 250, which means more than half the stocks in the S&P are below their 50-day moving average. We saw that on the other chart. But it's also below its moving average, which is starting to roll over. And again, that typically coincides with weakness in the markets. As you can see over with that black line is a chart of the S&P. So you see that the breadth across the board is you would expect us with the lack of volume, the lack of breadth, as tightly wound up as we are, and we've had a couple attempts to unwind. We can kind of see that they're there. The only bullishness we've had actually is coming off of those levels, off of those two bearish moves. So, it appears that one of these days, and with the breadth getting worse and worse, that one of these bearish moves is going to be the one that eventually just starts this intermediate decline and keeps us on it, ultimately getting us to, as I mentioned before, the dark pink shading and the red line that remember the Russell 2000 already is on, and that ultimately could start us on a more of a longer term move here. That again, the Russell 2000 is already on. The Russell 2000 is already below its 200-week moving average. Its 8 and 17-week moving averages have crossed below the 30 weeks. So when we are in a long-term bearish decline on the Russell, and the last time we started we started with the correction on the Russell when the S&P was forming a new high. Eventually, everything caught up with the same type of move, and you'd expect the S&P will catch up to IWM and work its way to below that line, just like IWM has. One last look at the volatility chart. So let's take a look at that. You can see the VIX is down below 17 by the end of the week at 82% as well. So very low levels. We've seen how low this has been. This is the lowest weekly close that we've had. We've had 3 really low weekly closes here on the VIX. Very, very small range. So we're getting some compression in the VIX from that perspective. When you look at the relative strength, again, we're back below 50%. Not the relative strength, the correlation. We're back below 50%. with the VVIX, because as the VIX has been down, the VVIX has not come down. In fact, is up above 100. Again, that negative correlation, even just getting below minus 50, typically leads to bullishness and volatility. And you expect, we've already had it below 0, and really below this line here at 40%. And we haven't even started that rise in volatility from that negative correlation, which can be pretty bearish. You can see you had a couple false starts over here as well, and a couple of other attempts to get below 50 before it really started to ramp up. With the banking crisis was your fundamental catalyst at that standpoint. And who knows what it will be this go around, whether it's the debt crisis, the debt ceiling or not. But we are setting up for a similar type of move, whatever the catalyst may be now on volatility, which obviously would correlate with weakness in the broader markets. You can see the correlation here between the VIX and the S&P is strong negative levels, and when you look at here, let's go out 20 years on this chart, you can see we do get a little pickup in volatility before the July 4th drop in volatility, before your bigger pickup that occurs typically throughout August, September, and October. Those 3 months tend to be very strong, especially when you have been as bearish as this drop that you typically get from March, middle of March to the middle of July. You get a drop in volatility. Well, we've already dropped 25% this year to date. We're setting ourselves up for a period of volatility that can ramp up a little bit now before it really ramps up over those, again, those 3 months that tend to be more volatile for the broader markets. All right, now let's take a quick look. That was a pretty long segment there. Let's take a quick look at some of these, how the different asset classes have moved here this week. Again, it's been a very, very quiet week, and you'll see that here as well. Start just at the beginning of the week. The dollar had the biggest move in the last 2 days. Look at the strength in the dollar. Very, very, very strong move, putting a lot of pressure on emerging markets that ended up being down 2%. Commodity prices were down 2%. Gold started the week relatively strong along with the dollar, but then finished down. You can see bonds rallied off their lows of the week. That's a strong move in UUP. You've broken above the 50 clearly, and you can see the MACD and stochastics rising. Got the point of control there at 28. It appears you're starting to make a run towards this gap, right? This 200-day moving average. Again, this is typically not bullish for equities to see that rise. Remember, bonds are coming off their lows of the week. They ended up down today, but look at the tight range. Talk about a tight range that they're in. Here's the weekly chart, kind of still stuck between the 30 and the 50-day moving averages at the low, but very, very big convergence here. The MACD and stochastics are down, so you got some weakness here. But again, you can see that how close we are to a big break to the upside in bonds, with a big gap there to fill between moving averages. So you do have as well as a 23% retracement. You're set up for a big move higher in these risk appetite or risk aversion trades, safety trades. Look at the weakness in commodities. This was one of the biggest down weeks. This was kind of an anomaly, right? As you can see, it was kind of a fake out, and then we bounced back up. This has been a 4-week decline back off the 30-day moving average, and now near these lows. MACD and stochastics dropping below their moving averages. We're in correction mode. Commodities just don't correct during bullish markets, and we are in correction mode and continues to be the case. Here's the daily chart, well below its moving averages and falling lower. And the 30 looks like it's about to cross back below the 50 as we trade below the value area. If I zoom out to the 2-year version of this chart, again, we're in the top of the value area with the point of control way down here. So you got the biggest volume down over here that's going to come off over the next month or two, and then that's going to be your volume node up there that we're already well below. So, you can see how much there's a lot of pressure on top of us and not very much pressure below us, and that leads to a path of least resistance to the downside for commodities, which again is not typical in bullish markets, right? It's bullish markets coincide with bullish economies fueled by rising commodities, and that's just not what we're seeing right now. The sector moves. Let's take a look at. You can see the Staples is kind of joining the party with technology, and this way outpacing discretionary here. But if I look at just today alone, so let's go out to May the 8th right there. If I look at today, or this week alone, XLC has been your biggest mover thanks to Google, right? Google had a big run. We talked about that was our trade idea for Wednesday. We pushed that up to now up to 2.5% almost for XLC. Materials and energy struggling with the strength in the dollar. They're pushing down. Industrials and financials pushing down as well. I've showed this chart, this 12 grid chart. It's such a difference here. You have these three up top that are all dark pink, dark green shading green lines. You have these four across the middle, and these are all technology, discretionary, and communication services. Make up a large percentage by themselves of the entire S&P. These four in the middle are also bullish cyclical sectors, but are more economic growth sensitive. These three aren't, but these four are. Energy, materials, kind of dollar sensitive as well. These two especially. Dark pink shading and red lines across the board. Almost a red line on financials. Has been already, right? In fact, you can see they've already been in this pattern, whereas these did not during that same time frame. A little bit there with the red line, but these have not been that strongly below their moving averages. And then you have light pink shading and yellow and green lines on these safety trades. So it is a clear distinction. I've never seen, and again, anecdotally, but in my years of paying attention to this, I've never seen such a distinct difference in the three rows. Because the three rows are kind of tied together. These are your FANG names, these are your cyclical stocks, and these are your safety trades at the bottom. They're tied together, and generally when you're bearish, they all go down. When you're coming off of a low, they all go up, and then they start to rotate. Well, you can see the rotation, and right now the rotation has been strong into that cyclical sector. Large cap growth. This is the large cap growth sector. Here's the daily version of that. Very, very strong growth, and you can see what's coming up here is small cap growth and mid cap growth starting to work their way up to the upside. When you look at the sectors here and go to a daily chart on the sectors, let's go to like a 10-day chart here so we can get 2 weeks. Look at energy really moving to the downside there. Let's do this one. Okay, well, let's do it that way. So look at technology, look at communication services. They've been bullish, XLY. In fact, you could argue that those are your three highest dots, right? So those are your three strongest momentum movers, even if XLC is moving down right now over the last couple of days on a relative basis. Technology has been. Your three relative strengths include XLK, XLC, and XLP. But you can see financials, materials. Here is utilities turning up, real estate turning down. That's a safety. It's not necessarily a safety trade right now. And then healthcare is XLV. It's right here. So healthcare is starting to work its way up. And if you look at the weekly version of this, look at utilities and healthcare and staples moving up to the right. Technology and communication services, very strong relative strength and haven't started to move yet. And your other cyclical areas moving down to the left. Clear change. And again, you see it in this chart. And you see how bullish sales are has led to that high outperformance of the Qs relative to IWM, which is so extreme right now you wouldn't expect to continue. And these are already bearish. You would expect these to come down, and these are showing relative strength. Again, if these start to roll over, then the S&P will too, following suit with what you're already seeing in the Dow and Russell 2000. So interesting, very interesting sector rotation right now that suggests we may be in the very, very mature phase of whatever bullishness we have at the last quarter of last year and the first quarter of this year. We might be in the mature, very mature phase of that strength before we start to rotate towards weakness. All right, now let's take a look at our trade idea of the day. So let me pull up to kind of go piggyback on this theme of how bullish we have been to the, and the potential weakness that might come forth from it. Lululemon, again, similar to the market, rallying at the close, had a bull tag for most of the day today. Intermediate line crossing below. Bear was also below at some early for most of the day too. The market sentiment line looks like you're just barely above it now. The bearish, a lot more bearish short-term sentiment at the lows of the day as well. But you can kind of see again the weakness that's developing here. When you look at the two-line versions of this 3 green arrow chart, we had 3 red arrows here briefly. You were easily below the 17 and the 30-day moving average at the lows of the day too. Even when during the Market Outlook Live, so that there's a late rally, because during the Market Outlook Live, which we do at 3:30 Eastern time when we put this trade on, we were below that. So it's the last half hour that we really rallied up, but you can see how long we've been in convergence mode, how susceptible we are to a new divergence mode, and how big of a gap there is in these moving averages. I mean, it's not a, and we're so extreme. If you look at like the RSI and the CCI, you'll see how extreme those moves have been. They're obviously not above 60 anymore, not above 0 anymore. So we are dropping towards bearish levels on that chart. When you look at the 4-week range, we are way down below the high end, below the midpoint of the 4-week range, and well below the average. So definitely turning bearish from that perspective. And we are well above the cloud, and you can see kind of where we were. Again, we were about right here, the red line, so we were a lot closer even on that. Again, with a half hour to go. But you see how extreme, how big of a gap there is between the blue line and the cloud, and that can lead to weakness, as we saw in really the last 2 times that we've been up near this level, here and then here too. When we've had that big gap, it fills it in towards that cloud. Let's take a look at the Bollinger Bands, and the Bollinger Bands have been so wide because we moved up so much on the earnings. But now look at the bandwidth after spiking up to 150-day highs, has broken below 150-day lows, and we're in the middle. We were in the lower half again earlier. But look at the bands moving inside the Keltner channel. So again, we're set up for that kind of move. Again, we saw it right there before things hit the fan and turned down to the downside there. Very similar, and we also saw it over here where we had the big move. The bands got inside the Keltner channel right before it reversed back to the downside. So at the same time that we hit this level, looking at the weekly chart for Lululemon as well, you can see the change in direction we had on the weekly chart here. Eventually, such big bullish candles right in the Heikin-Ashi differential has been below its moving average. The PPO at a high level, higher than the last 2 times we were at these points. So pretty strong PPO here on a golden cross. But you see the transition candle, right? The transition candle, this one didn't get a transition. We just turned right down with the lower close, and we got the transition there. And then now this is our transition. So you're looking for continued weakness. And like I said, with that Bollinger bandwidth, looking into this June expiration of how far we can go down, as far up above the point of control in the value area we are. There's not a lot of support down to the value area, even down to 329. So what I decided to do, be really aggressive with a long put vertical spread. I sold the 330 right at the bottom of that 1 standard deviation cone. Bought the 340 to keep the cost low, so the risk is really small, less than $500, and we don't even have to take that unless we get maximum loss. But the gain is 5 times. So if we get down to that 330 level, we start to fill in that gap where there's very, very little support, then we can get a really, really good reward for a very small amount of risk on this trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all next time.